What is a stock? A stock is a small piece of ownership in a company called a share. There are two ways to make money from owning stock. First, the company may pay stock owners a portion of its yearly profits. Those payments are called dividends, and stocks that pay dividends are called value stocks. Second, the company may increase in value. This typically means your stock will increase in value. If this happens, you could sell the stock for more money than you paid. The profits from selling your stock are called capital gains. Stocks of growing companies are called growth stocks. Aspire to Money is not an investment advisor and does not make investment recommendations. There are two ways that you can buy stocks: individual stocks and stock funds. Individual stocks. You can buy the stock of an individual company. Even if you research the company thoroughly, though, there are risks to owning the stock of only one company. For example, if something bad happens to the company, the stock of the one company you own may go down more than the stocks of other companies. To use investment lingo, you have not diversified your risk by holding only one company. But if you are a beginner investor, you may not have enough money to be able to buy shares in multiple companies to be diversified. Now let's talk about funds. To be safer, you might decide on an investment fund. You and other investors pool your money together and buy stocks or shares in a number of companies. Owning stocks from a number of companies is called diversification. This is an important way to reduce risk. Two of the most popular types of funds that you can buy are exchange-traded funds and mutual funds. Exchange-traded funds, or ETFs, are traded on public stock exchanges. They're usually, but not always, passive investment pools where the fund manager only makes minor changes now and then to keep the fund in line with its index. The manager of an ETF has to buy all of the stocks in the index it is trying to match. For example, an ETF based on the Dow Jones Industrial Average will buy and hold the 30 stocks that comprise the Dow Jones Industrial Average. An ETF based on the Standard & Poor's 500, also called the S&P 500, will buy and hold the 500 stocks in that index. The idea behind passive investing is to match the return of a particular index. The management of the ETF doesn't make the decision as to which stock is better than another stock. The ETF simply owns all the stocks in an index, like the Dow Jones Industrial Average. Now, let's talk about stock mutual funds. Stock mutual funds are not bought and sold on a public stock exchange. Often, but not always, a stock mutual fund is an active investment fund. What does that mean? It means that the management of a stock mutual fund makes active decisions as to which stocks have better financial prospects than other stocks, and then buys those stocks that have better prospects. The philosophies that the stock mutual fund management uses to make those judgments can vary widely. One common difference is between a value philosophy and a growth philosophy. The management may follow a value-based philosophy focusing on stocks that it believes are undervalued. Or the management may follow a growth-based philosophy, focusing on the stocks of companies that are growing rapidly. Check out the Aspire to Money video about the essays of Warren Buffett for more information on the value-based investing philosophy. Both ETFs and stock mutual funds charge you a small amount for management expenses. Exchange-traded funds are generally cheaper. Some people argue that passive exchange-traded funds show better performance than active stock mutual funds. However, some stock mutual funds have good results as well. Also, the theory is that their active managers may be able to either avoid losses or reduce losses in bad markets when compared to passive ETFs that keep holding no matter what the circumstances are. Never invest your money in something that you do not understand. Remember, if it sounds too good to be true, it very likely isn't good and isn't true. Consult with your investment advisor. Insist that he or she explain any investment to you thoroughly. You should never feel rushed or pressured to make a decision. Make sure to do your own due diligence as well. Then start investing wisely in your future.